If you're new to the stock market, it can also feel overwhelming. Don't worry, in this video, I'll break down everything you need to know to start investing in the US stock market. Whether you're saving for retirement, a dream vacation, or just want to grow your wealth, this guide is for you. Let's get started. What is the stock market? Before we dive in, let's answer the most basic question. What is the stock market? Simply put, it's a place where you can buy and sell shares of companies. When you buy a stock, you own a tiny piece of that company. If the company does well, your investment grows. If it doesn't, you could lose money. That's why understanding how the stock market works is so important. Think of the stock market as a giant auction house. Buyers and sellers come together to trade shares of companies. The price of each stock is determined by supply and demand. If more people want to buy a stock, the price goes up. If more people want to sell, the price goes down. The two most famous stock exchanges in the US are the New York Stock Exchange, NYSE, and NASDAQ. The NYSE is the largest in the world, with companies like Coca-Cola and Walmart listed there. NASDAQ is known for tech giants like Apple, Amazon, and Google. Let's start with some key terms you'll hear a lot. Stock, a share of ownership in a company. Index, a group of stocks that represent a part of the market, like the S&P 500 or Dow Jones. Dividend, a portion of a company's profits paid to shareholders. Portfolio, your collection of investments. Brokerage account, the platform you use to buy and sell stocks. Think of a brokerage account like a shopping cart for stocks. Popular platforms like Robinhood, Fidelity, and E-Trade make it easy to get started. Here are a few more terms to know. Bull market, when stock prices are rising. Bear market, when stock prices are falling. ETF, exchange-traded fund, a basket of stocks that tracks an index or sector. IPO, initial public offering, when a company first sells shares to the public. How the stock market works. Now, let's talk about how the stock market works. The US stock market operates through exchanges like the New York Stock Exchange, NYSE, and NASDAQ. These are like giant marketplaces where buyers and sellers meet. Prices go up and down based on supply and demand. If more people want to buy a stock, the price rises. If more people want to sell, the price falls. But don't worry, you don't need to be on the trading floor to invest. With a smartphone and a brokerage account, you can trade from anywhere. Here's an example. Let's say you buy one share of Apple for $150. If Apple stock price are assessed $150. If Apple stock price are assessed $200, you can sell it for a 50 profit. Beautif thepers drops to 50 profit. Beautif thepers drops to 100. You'll lose $50. That's why it's important to research before you invest. Why invest in the stock market? Now, you might be wondering, why should I invest in the stock market? Here are 3 reasons. Wealth growth. Historically, the stock market has returned an average of 10% per year. That's much higher than savings accounts or bonds. Beat inflation. If you leave your money in a savings account, inflation can erode its value over time. Investing helps your money grow faster than inflation. Passive income. Some stocks pay dividends, which can provide a steady stream of income. For example, if you invested $17,000 today, that's the power of compound interest. How to start investing? Okay, so how do you actually start investing? Here's a step-by-step guide. Step 1, set your goals. Ask yourself, why am I investing? Is it for retirement, a down payment on a house, or just to grow your wealth? Your goals will determine your strategy. Step 2, choose a brokerage. Pick a platform that fits your needs. Look for low fees, a user-friendly interface, and educational resources. Step 3, start small. You don't need thousands of dollars to begin. Many platforms let you start with just 10 or 20. Step 4, research stocks. Look for companies you believe in. Do they have strong financials? Are they growing? Tools like Yahoo Finance and Morningstar can help. Step 5, diversify. Don't put all your money into one stock. Spread it across different industries to reduce risk. Risk management. Speaking of risk, let's talk about risk management. The stock market can be volatile. Prices can swing wildly in a single day. That's why it's important to invest for the long term. Don't panic if the market drops. Historically, it always recovers. Diversify, spread your investments across stocks, bonds, and ETFs. Avoid emotional decisions, stick to your plan, even when the market gets shaky. Building a beginner's portfolio. Now, let's build a beginner's portfolio. Here's a simple strategy. Index funds or ETFs. These track the entire market and are great for beginners. Examples include VOO, SP 500 ETF, or VTI, Total Stock Market ETF. Blue chip stocks. These are shares of large, stable companies like Apple, Microsoft, or Coca-Cola. Dividend stocks. Companies like Johnson & Johnson or Procter & Gamble pay regular dividends, giving you passive income. Growth stocks. Companies like Tesla or Amazon have high growth potential but come with higher risk. Pro tips for beginners. Before you start investing, here are a few pro tips. Avoid timing the market. No one can predict the best time to buy or sell. Keep fees low. High fees can eat into your returns. Stay informed, follow financial news, but don't let it dictate your decisions. Be patient. Investing is a marathon, not a sprint. Common mistakes to avoid. Here are some common mistakes beginners make. Investing without a plan. Always have clear goals and a strategy. Chasing hot stocks. Just because a stock is trending doesn't mean it's a good investment. Ignoring fees. Even small fees can add up over time. Panic selling. Don't sell during a market downturn. Stay calm and stick to your plan. Real-life case studies. Let's look at some real-life examples. Amazon. If you invested 1,000 in Amazon in 1997, it would be worth over 1,000 in Amazon in 1997, it would be worth over 1.5 million today. Apple, a 1,000 investment in a plane 1980 would be worth over 1,000 investment in a plane 1980 would be worth over 500,000 today. Tesla, a 1,000 investment in Tesla in 2010 would be worth over 1,000 investment in Tesla in 2010 would be worth over 200,000 today. If you found this video helpful, give it a thumbs up and subscribe to my channel for more tips on personal finance and investing. Got questions? Drop them in the comments below. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.